Welcome to the Investing Show, where we discuss ideas to help you make more of your money and talk about the news that investors need to know about. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Richard Hunter of Wilson King Investment Management.
Oh, Simon.
Hello, Richard. And Nick Batsford of TipTV.
Simon.
Coming up later on today's show, we're going to be talking to Marcus Brookes in the second part, discussing what investors can do when they're choosing funds for their ISAs and giving you some ideas too. But first, a quick look at some of the things that have been in the news. Well, for investors over here, one of the things is that the FTSE 100 has continued to make record highs. A very strange scenario for those of us who waited oh so long after 1999 for it to regain its peak. But inflation is also up to 2.3%, and we have a new measure called CPIH, which includes some housing costs. And other than that, well, there's the usual stuff rumbling on. Bit of Brexit, bit of Trump, bit of this and that. But what do you need to know about in the next 2 weeks before you're investing your ISA? Well, first, quick chat with Mr. Richard Hunter, who has some concerns and actually wants the stock market to come down. Is that true?
Almost. I couldn't say that I wanted it to come down, but I think it is due to come down. If you look back over what has been a fairly exceptional last 12 months or so, you've had the turbocharge in terms of the FTSE 100, obviously driven largely ahead by weak sterling, and in the States you've had this incredible amount of optimism simply on the basis of the election of Donald Trump. Now, what the market has chosen to do, pretty much on both sides of the ponds, is to take absolutely the optimistic route that in the UK, perhaps Brexit won't be such a bad thing after all, and that in the US, Obamacare will be reformed, there will be tax reforms, there will be infrastructure spending and so on. And the markets are pricing that into the hilt. In the US, as a minimum, those sort of things are going to take 12 to 18 months to be implemented, let alone agreed. In the UK, we can't start to guess about what the ramifications of Brexit might be until we've triggered Article 50 and we start to hear how the negotiations are going. All that being said, it's kind of feeling with, admittedly, the index levels per se aren't that important, but we keep seeing the headlines record highs, but it's starting to feel as though some of the air needs to be let out of the tyres, just so we can reset expectations. Market is obviously a discounting mechanism, hence the highs. It's trying to predict what will be happening in 9 or 12 months' time. But what that also means is that it's kind of building itself up for a fall if any of those things that it's expecting don't come to fruition.
So essentially, investors are getting ahead of themselves in a way. They're just chasing prices up, really. It's that classic thing, isn't it, of I must buy today, because if I don't buy today, it's going to be more expensive tomorrow and I'm going to miss out, and then it's going to be more expensive the next day.
Yeah,
and that's how that mentality works.
Yes, it does. It does. Almost in a sort of momentum way. The question is, as we have not been seeing for the last few years, we are pretty much at the peak in terms of optimism, and it's possible that all of those things will come to fruition. By the same token, I suggest that it has been pretty much a straight line increase since A, Brexit and B, Trump. We've just had no correction coming along at any time, no reset of expectations or indeed sentiment. And it may just be that if companies are continuing to report strongly, when we do have hopefully a small correction, that could actually present a buying opportunity for those people still sitting, and there are many, still sitting on the sidelines with their cash earning zip on their money.
Yes, indeed. NatWest, ISA countdown clock, on its website. You only have a limited amount of time to get this. You click through a cash ISA paying 0.01%.
Well,
yes, that really does exist. That really does exist. Which begs the question of why you'd even offer that. But also, does anybody take that out? Who takes that out? We'll try and find that out. Nick, something that might help save us. Something that might help save us.
This is the press review. Hamish McRae in the Evening Standard. This boom is pointing to a steep hike in interest rates. Not sure I agree, but there you go. He's suggesting we're in a boom, certainly in a financial boom. And I picked up in another paper, even pocket money is a 10-year high for the kids. Right, what's the weekly average?
It's £7.
Right, okay, you wrote the article.
I read the story.
Okay,
No, I read the story. I read the story.
can't
And do you
do
know
that.
what? Someone said to me, I can't believe that's £7. And I said, yeah, but think about it. So say you've got like a 13 or 14-year-old kid and you give them £7 for the weekend to go out with their friends and do something. What can you actually do for less than £7 nowadays? That was my
I can't think of anything.
No. Sorry,
Right,
completely derailed you.
FTSE, record highs, the Dow past 20,000, sort of going to 21,000, suggesting that the UK and US economies are running at full capacity. Unemployment at 4.7%, equal to the lowest since 1975 in the UK. In unemployment in the US, similarly 4.7%. And saying that in terms of the US unemployment, you'd have to go back to the 60s to see that sort of that level. So that's obviously good news. Now, in terms of consumer prices, up 2.7% on the year, highest rate for 5 years. UK consumer prices are above 2% now, and obviously the Bank of England's inflation target were above that. He's suggesting not amber, but not red, but amber. So he's on guard. He's on the back of the Federal Reserve raising rates. He's saying if we didn't have Brexit, hadn't have had that, we would have had a rate increase by now. And I think that's a good point. In terms of old money, there was an interesting statistic I read that in terms of the devaluation of the British pound, sterling's fallen by 15%. In the normal course of action, the bank that equates roughly to about a 4% interest rate cut. In old money. So that's worth noting. Housing costs. Obviously, real wages being held down. Ultra cheap money policies, central banks. Houses, record highs, 7 times average earnings, he's suggesting. And he's saying that the central banks, that in terms of the policy, they should lean against booms by increasing interest rates. And there was an old Fed guy, William Martin, the chairman of the US Federal Reserve, 51 to 70, basically saying it's the job of the Fed to take away the punch bowl just as the party gets going. Finally, prepare his headlines, prepare for a sharper rise in rates, certainly in the US, but also in the UK, than people currently expect.
Well, that was the reason why they said they had to raise them in the US at the end of last year, wasn't it? Because if they didn't raise them, they'd have to raise them.
If they fall behind the curve, you'll have that stock market correction.
But I think what we've seen up until now, certainly in the UK, is the Bank of England just has not wanted to raise rates because it fears being held responsible for derailing the recovery. Then you had Brexit, then you had a rate cut, and then you had the same old excuse rearing its head. But we did have one person on the MPC voting for a rate rise, didn't we? Back to the heady heights of 0.5%.
That's right, and the inflation figure that Nick mentioned, which is now just above the headline or target of 2%, in normal circumstances would open up the interest rate hike debate. But if the UK economy is in a boom, I'm not entirely convinced it feels like one. Wage inflation still hasn't really kicked in. And some of that inflation comparison is bolstered not only by last year's oil price, but also by the very weakness in sterling. Our imports are now more expensive. That's inflationary. So it doesn't feel like quite the right time to be raising interest rates in the UK just yet. And I think we'd be fairly surprised if we saw one this year at all.
I think we might see one. I think we might go back to 0.5% by the end of the year. And I think that we will then stay there and achieve our decade of rates of no higher than 0.5%. But we shall see, won't we? That's all for the first half of the show. Join us in the second half of the show for Marcus Brookes of Schroders, who's going to help you pick some funds for your ISA. Thank you very much. Goodbye. Welcome back to the Investing Show. Joining us in the studio, we've got Schroders Head of Multi-Manager, Marcus Brookes. Marcus, welcome to the show.
Thank you.
It's ISA season, which means that people are out there looking at where to invest their money, which funds to choose. But they face an unusual situation, even in a run of years of unusual situations this year, don't they? I think we always talk about uncertainty. I think probably last year when we had you on the show, we were talking about uncertainty. But that sense of uncertainty appears to be heightened, doesn't it? I mean, what is going on out there in the investing world, in your eyes?
Well, blimey, what a great start. So if you go back to 2016, I think most people were reasonably happy that the global economy was going to be okay. and therefore a lot of sort of pro-cyclical assets, things like equities or shares, they would be the place to go to. And then there was just this surprise in the first half of 16 that global growth kind of slowed slightly. And it led to a massive panic that there was going to be the rise of a deflationary shock, which may even lead to a recession. And you could see that in the stock market in February of last year. It was a big down. And then the way that it recovered wasn't with any sort of certainty. And then we had Brexit. And everyone was convinced that if we voted for Brexit, that would be bad for markets, but markets went up. And then we had the debate about who was going to become president of America, and it was decided that if it was Mr. Trump, that markets would go down, and he got in, and the markets went up. So we find ourselves in 2017 looking back on a year full of confusion, actually. But I think the one story that remains solid is the global economy is absolutely okay. We're seeing very low levels of unemployment in most of the Western world. The inflation statistics have just started picking up again. And I think that's the really big story now for this market move next. So when I'm thinking about funds, I'm thinking about a different environment, not of a deflationary burst or recession. I'm thinking, well, the world is okay. We've got enough growth for this to continue for a while. Any worry that we had about super low levels of inflation, I think we can put that to one side for the time being. So maybe we need to be a bit more optimistic in our fund selection for 2017.
So we've got this slightly strange scenario where basically we've established that people are more worried than they were a year ago, but investors appear to be less worried, which is going back to that suggestion that we're shifting from just more of the same. I think we've seen since the financial crisis a lot of more of the same, haven't we? To potentially, you're saying we've now moved into a different box in where we should be investing.
Yeah, I think the box that we've been in for the last 5 years has been a box that was predicated on very low commodity prices in particular, that depressed inflation. And I think that got a lot of people worried that the financial crisis never finished, that these very low levels of growth that we were experiencing were just one misstep away from perhaps going into recession. Was a kind of think that 2016 was the transition year that we've been finally waiting for, which is that we can't get super bullish on the global economy being fantastic for the next 5 years. But I do think that any threat of recession, for the moment at least, looks like it's 2, 3, 4, 5 years away. Whereas I think we could have probably convinced ourselves in 2016 that it was just around the corner. So with that in mind, the sort of portfolio that you need for a slightly more expansionary, slightly more bullish environment, I think is very different to the one that you've had for the previous 6 years, if you've outperformed, that is. Because with a little bit of economic growth, it allows companies just to make a bit more profit, which allows share prices to go up. Now, there are still some areas I think are very expensive. The US equity market, I think, is phenomenally expensive, actually. It's been the safe haven that investors have chosen to hide in. But areas like Europe, Japan, even global emerging markets, these are areas that now I think with a bit of a tailwind can really do well for investors' portfolios.
And there's companies within there that presumably are going to benefit from a little bit more growth going on. What kind of companies are there that fit within that box?
Well, I think it's better to focus on the companies that have just done really well and perhaps you don't want to have anymore. So anything that grew a little bit every year, something like a food company or a tobacco company or pharmaceuticals, those are the firms that have done really, really well. And for this next phase, I would argue you probably need to get away from those because those have been the safe areas. The areas that have done poorly, things like financials, things like materials, energy, these are areas of the stock market and of the economy that tend to do quite well when we're all feeling a bit more optimistic and there's a little bit of growth. So I would be saying, as you look through your portfolio, just make sure you've got a bit more exposure to financials, commodities and energy. These have been the areas that have been dreadful for 5 years, and maybe it's their turn in the sun.
And one of your jobs is picking funds, isn't it? As head of multi-manager, you have to go out there and you have to look at all of the different funds on offer and choose what you think are the best ones in the best opportunities. Can you run us through for our viewers, obviously, who are in the same position, but obviously not choosing it for quite so many people as you are. How do you work that process? What do you do?
So what we're trying to do is look at where we think the economy is going to go and work out what the beneficiaries of that movement is going to be. So as I was just saying, we quite like Japan, we quite like Europe, we quite like emerging markets. But within that, don't just go and buy any old European or Japanese or emerging market fund. I'd be looking at those funds that have possibly had a bit of a tough time for the previous 5 years, because in this changing environment, a changing investment style, the way that the fund manager invests is going to be, I think, a little bit more important, actually. So we like, for instance, the Artemis Global Emerging Markets Fund. It's only 2 years old. It hasn't had a tough time, so it goes against my rule. But The process that they're using there is a quantitative approach. It's a little bit value oriented, and it does have exposure to things like commodities and energy companies in emerging markets. So I think that's a really neat idea. It's quite small. It's managed by Rahil Altaf and Peter Saka of Artemis, and it's got a cracking 2-year track record. It's really picking up on that theme. In Europe, we'd say someone like Invesco Perpetual European Growth, managed by Jeff Taylor. Jeff is, again, another value investor. And value in Europe means commodities, energy, and financials. So again, that's very much on theme with what we're looking at. And Europe has had so many problems in the last 5 years. It's far, far cheaper than the US. And I think this is a cheaper than market fund in the way that it invests. So I think Jeff's fund is also very interesting. And then in Asia, another pickup area, we could see Jonathan Pine's fund, Hermes Asia ex Japan. Again, another value investor. Again, financials are very much present in that fund. So I think those are 3 really good opportunities for that sort of theme for what we're about to go to next.
You mentioned Europe. Are you including the UK in that at the moment in terms of as an investment destination, if you like, and whether you are or you're not? What's your kind of view of UK growth once you've stripped out the weak sterling impact, obviously?
Yeah, absolutely. So the UK for us is actually okay. It's an okay economy. There's an awful lot of angst surrounding Brexit, what it means for our economy. But when you look at the raw data, there's been a little bit of disappointment about the retail sales numbers. But if you can kind of put that to one side, the rest of it looks pretty good. We've got very low interest rates in this country. I think that's going to be supportive. Arguably, we should have raised rates by now. So I can just see the tailwind of the global economy doing quite well, being useful for the UK. So long as Brexit doesn't go too badly wrong, I don't think that we would be hindered too much. And with a cheap currency, I think some of the larger companies, the FTSE 100, they could do very well. And again, if you look at the FTSE 100, what's in there? Energy companies like BP and Shell, mining companies, financial companies. So I would be relatively positively disposed to the UK stock market, definitely.
Right.
And Richard, you're there on a daily basis looking at companies, aren't you, reporting and what investors are investing in. And this process that Marcus just described of basically not looking at what's just done well and choosing that, but looking for stuff that's not done so well, that is the complete opposite of what most people do, don't they? They look at a list and then they press the button at the top of the list that orders it by performance over the last 3-5 years. Yeah,
that's right. And I think that's one of the reasons you've got to be so absolutely strict on yourself. And where you start there, of course, is in terms of attitude to risk. I think it's fairly undeniable that compared to the good old days of 10 years ago plus, the banks, for example, are no longer low-risk investments. In fact, they're trading, they're almost displaying a lot of characteristics of a trading stock at the moment rather than investing stock, particularly in the retail space. But given what we've been talking about at this particular potential inflection point, they're certainly worth another look, the financials. And of course, when you're talking about commodity and mining stocks, they've had pretty much since the financial crisis quite a long time to get their financial houses in order. And generally speaking, they're much better run companies than they were perhaps 5-10 years ago.
Mm. When you look at the funds that are looking for that kind of company that we were just talking about, do they tend to be more the kind of special situations type funds that are out there? And if so, how do you evaluate a fund and its manager on their views on such things in terms of, I think that thing's done badly, but I think it's going to do well, versus I think that thing's done badly, so I'm just going to buy it because if you keep buying things that go down, eventually they'll go up. That's the really difficult one for investors, isn't it?
Yeah, it is, because you can buy something that's done badly and then it goes bust on you and you just lose 100% of your capital, which no one really wants to do. I think a diversified approach is obviously the best way. We run £3 billion sterling in multi-manager assets and I advise on another 35 billion. So with that critical mass behind us, we get to see and spend time with fund managers and talk to them about their portfolio, talk to them why they think such and such energy company is in a great position, or why the mining industry as a whole is. They had a massive capex explosion in capex from 2001 through to 2007. 2007 to 2008 was a near-death environment for them. Then they had a bit of a pickup, and then from 11 through to basically 15 or 16, again, a really, really tough time for them. So we're looking at a 10-year process, I would argue, of taking out excess capacity. So that's our observation. Then you go and talk to someone who runs a commodity fund or is just overweight commodities. And you can talk to them, I see you're overweight mining, explain to me your investment case for that. And hopefully it chimes with our own, and that allows us to have the confidence to invest with them.
And if you decide that you think a fund looks good, you decide that a fund manager sounds good, you like their approach, what sort of timescale are you looking at for that idea to deliver?
Well, we're looking for a return that's suitable. So if I get all that return that I'm expecting, and let's not put a number on it, but let's just say I've got an X number that I'm expecting, and I get it in 2 weeks, well, I kind of, unless there's new news, I've kind of got to sell. Realistically, though, just because we spot a cheap opportunity, it doesn't mean that the market will get there straight away, and it could take 3, 6, 9, even 12 months. So I would look at our turnover statistics. It tends to be around about a quarter of the portfolio a year. So on that basis, we would hold a fund for around about 4 years. But there's lots of topping and tailing as well. Because the other thing is, I think, psychologically as a fund manager, as things go up, you kind of get that emotional pat on the back of, you've got this right, go and buy some more. And actually, you know from history, you should actually be selling it. So if it was a really good idea and there was this much opportunity, it's gone up, the opportunity should be shrinking unless there's new news. So therefore, you want a smaller position. So just take some of the profit off your winners. You don't have to cut it completely. And then maybe some of the ideas that are taking a little bit more time to work, put a bit more capital there, and then maybe that'll be the next runner in your portfolio.
And one final thing I was going to ask you about is Japan. Now, obviously, Japan is a market that for many, many years, people have said, right, no, Japan, finally going to turn around, finally going to turn around. And we've seen some signs that it has made something of a turnaround. It's certainly made some investors quite a lot of money who put some money into it, 3, 4 years ago.
Yeah.
Do you think that recovery can continue in Japan? Is Japan a place that's worth investing in?
I think Japan is worth investing in, but it's less to do with the economy, it's more to do with the companies. So Japan, as most people know, it's an exporting stock market. Lots of Hondas, they sell a lot of Hondas in Japan, but they sell them all over the world. So we can look at the valuation of the average share in Japan and say, actually, it's fairly reasonably priced. Nothing in this world is cheap at the moment after a bull market that's been going on for the best part of 9 years. So we can say it's reasonably priced. We can see the backdrop where the global economy is doing okay, so therefore earnings might pick up, and the multiple that we're paying for that share is actually reasonable for us. Now, then you look at what the Japanese government are doing, and they've kept interest rates really low, and they even played with the idea of having negative interest rates permanently. Now that almost sent their financial system into meltdown. They realised pretty quickly, backed away from that. But what it meant was...
The rest of the world didn't like it much either, did it?
But what it meant was that you've got corporate Japan now with super low levels of cost of debt, so they can invest and they can sell more products. So when I compare the Japanese valuation to the US valuation, Japan is so much cheaper. So I wouldn't necessarily look to see if the 5 arrows that Mr. Abe was bringing are necessarily working. It's not really about that. There is some reform going on in the Japanese economy. There's still some very strong headwinds that are 10, 20 years out, and not least demographics. But from a stock market principle, I think it's relatively cheap and we should have a go.
Marcus, and finally, I did say that was the last question, but I'll ask you one more question. If you had a tip for an investor, for one of our viewers, in looking for funds or looking to invest their ISA in the next 2 weeks, what would be your idea that would help them in their investing?
Well, I'm not a regulator to give individuals advice. However, from my own standpoint, I think that the emerging markets backdrop is looking very good. All the political scandals have got people worried about Russia and Brazil. Maybe Russia hasn't been resolved yet, but certainly Brazil, and to a degree some of the South African issues in India. I think the politics is less of a worry for emerging markets. I think the valuations look, even after a relatively good year in 2016, and I think some of those tailwinds about the global economy doing quite well, I think the emerging market sector's due a comeback, and it's certainly trailed the US equity market substantially. So that would be my tip.
Excellent. Marcus, thank you very much. Richard, thank you very much. And my tip would be, listen to Marcus, but do your own research. That's very important. Thank you very much for watching. See you next time. Goodbye.